Hello and welcome to KYC, Know Your Counterparty, with PM Insights. This week, I'm your host, Nicholas Fusco, and today we're joined by Edoardo Zarghetta, and would love him to introduce himself and tell us a bit on how he found his way into private markets.
Thanks, Nick. So my name is Edoardo. I've been working in the private market since 2020. After 20 years career in banking, I worked in OTC market, over the counters, and I found myself investing in private companies already in 18. My first investments were Palantir and Airbnb, and then I started to see some kind of similarities in the way the market works for fixed income OTC and private companies. And I said to myself, well, this is much more interesting than do bonds. Back in the days when I did bonds, the interest rate in 10-year bond was minus 50 cents. So clients were happy. We're happy if you brought them a product that would give them minus 40 cents. So you can imagine that the fun we had at the time, not so much. So I decided to flip and to pivot, and I quit the bank and I started to invest professionally in startup and private companies.
Great. Well, you and I both. I think some of the audience here knows that I was in OTC markets since 2006, and I will say you and I both found our way to private VC-backed secondaries land. You know, it's definitely a lot more exciting to invest in companies like Palantir than a fan brief or something like that.
Yeah, correct.
In Germany, right? So, yeah. Also, I think a big difference is the clients we end up servicing in this sort of market are dramatically different than some of the core institutions. You know, a lot of insurance companies for the bonds market, fixed income, correct. OTC. Would love to hear about what the types of clients are that you service today, and why that might have been difficult, you know, at first to completely change your book, or why you really like it, you know.
Yeah, so the book of clients I had at the bank was not very useful for this job because, as you say, there were big institutional clients who bought fixed income. So I couldn't really leverage on those relationship. What we did was, so first of all, we did a couple of investments as a private individuals, my partner and I, Rudolf Gentile and I, and then we saw that we liked it. And then when we opened IPO Club and we started to offer the investments to other people, as everyone does, we went to family, friends, and then we spread by word of mouth. At the same time, it was an exciting market at the time. The market was very sparkling, so there was a lot of interest in private companies. So we were lucky to kind of launch at a good time that allow us to get in contact with the right clients who were looking for our asset class, mainly online. So the kind of client that we service are high net worth individuals who either invest directly or via a family office or via a self-directed IRA. I see a lot of benefits in putting your self-directed IRA money in this kind of asset class because it's a long-term play. And right. It doesn't move very much, so you don't really buy and sell. So the pension money is actually the best pot of money that you can use for venture capital. So between 20 and 24, we have accumulated a number of what we call members in the club, in the IPO club, and they are individuals, some with ridiculous amount of money and some not with ridiculous amount of money, just make it into the accredited investor status. So one, just to give you the two sides, sure. One is an extremely wealthy person with a family office in multiple cities worldwide.
Oh, wow.
So he has actually, like people working for him, making investments for him. He sold a big company to a larger corporate, and then he started to invest his own money. And then on the opposite side of the spectrum, I think I have a taxi driver from New Jersey who actually, is a big hustler, and he saves money, and then he calls me every 5-6 months and say, what can we buy? I saved X. What can we buy? What is it good to buy? So that I gave you the total spectrum of the client we service.
Sure, and that's super interesting because, I mean, well, hopefully the taxi driver owns the medallion or several. The medallion market's been pretty wild here in terms of value. But are they actually investing in similar products, or are you really focused on more of a suite? Because I think the sweet spot is the late stage for you, is my understanding. Is that right?
Yeah, so we did a change at the end of 2024. So what happened? So as I was saying, we started with extremely good markets in 21, and then we went into some kind of, a private market recession, if you
Right.
want, where in 22, 23, no one went public, the interest rates shot up. Then we had the war in Ukraine, a lot of uncertainty, the IPO window closed. And so what happened is that, there weren't like so many new clients coming in every day as in 2021. Servicing the clients that we had onboarded, I noticed in around the beginning of 24 that the performance of our book as general partners, being exposed to all the names in the portfolio, some with bigger positions, some with smaller positions, depending also, what kind of deal, how much we got in when we bought into the startup. Our book was performing better than at least half of the clients that were into the club who had bought maybe one or two names because they had strong convictions. I always make the example, it's an unfortunate example, is Impossible Food. Impossible Food seemed to be in 2018 to start. The CEO of Beyond Meat was on newspaper covers, no? It was
Right.
on Newsweek. So it was a huge phenomenon. So we bought in 2021, and then it started to suffer. And even today, it hasn't really recovered or follow on what's going on in the market in 24, 25. So when I started to see that we as manager were performing better than a lot of the clients, I kind of felt sorry that there were a lot of people who were involved and were not enjoying our results. Also, a few of the clients that we had onboarded in the first 4 years often asked, do you have a managed product? Can you help me choose which companies to buy? And the regulation, Nick, we can't give any financial advice. So if someone would call me and say, I have 1 million, please tell me which companies to invest in, I have to hang up. I can't give any financial advice. We can
You're
only
more polite than hanging up, but
yeah.
but right.
But we can only say, do you want to invest in SpaceX, Anduril, Epic Games? What do you want?
Right.
We'll give it
here
to
are
you.
your options.
Yeah.
But there was always that other option lingering off in the distance that probably made more sense, because
The managed product.
right. Okay.
Yeah. So we used all of 24 to study a formula that we think would be successful in the next 6 years, and we came up with a kind of a bit of a secret sauce that includes investing in energy, defense, cybersecurity, and AI infrastructure for a period of 6 months. 6 years, sorry, 6 months would be the fun brief you were mentioning before. So for 6 years, investing only in Series B onward rounds through the secondary market, and then via follow-on rounds into our biggest convictions, add via the primary market. So,
okay. So just for me to clarify, your secret sauce, you effectively did a look back and said, what did we do as the club in totality? What has worked really well? And then one thing that you're able to leverage here, which is interesting, is you're also able to go a little bit risk on and a little bit earlier stage because you're diversifying out with a fund structure rather than a single name.
So we start at Series B.
Right. That's great.
And,
okay, but you said 6 months. I know that was a mistake. You said 6 years. That sounds short. That sounds unique because I think in a lot of ways, most venture funds are really creeping up around the 10-year mark. But even there was an article published by Institutional Investor, The New Reality of the 14-Year Venture Capital Fund. 6 years 14 versus 10 or 14 is incredibly short. So what in your background is making it easier for you to achieve, staying true to that 6-year mark on duration?
Yeah, so those funds are venture capital funds. They are the old school funds.
Right.
We realized that there is a new market in between the venture capital model and the public market model. And they are the private markets, the one that you navigate every day with your information and pricing. with your valuable contributions. So that market means that if our fund is geared to sell paper on the secondary market, not to wait for IPO or M&A.
Right.
So we buy if we are convinced that we can sell that position to another investor, as you would do on the public market. So we buy and sell on the secondary market, and we only make sure that we buy things that will appreciate and return at least 4x in the period. So the way we structure the fund, we raise money over 3 years. This raising money over 3 years allow us to be exposed to 3 vintages of paper, from 25, right, 26, 27, and then and also allow us to dollar average. It allows us to build a position and play we take something out of the venture capital world, which is like, if a company you have in your portfolio because you bought it on the secondary has a follow-on round, do you follow on? Do you fold, or do you double, like in poker a little bit?
Right.
So we do that over 3 years, and then on year 4, 5, and 6 we stop fundraising. Everybody's in, and then when we see that the paper we bought performed, or there are not so much upside left, we start selling. And we bring the liquidity in, and we return the money to the client by December 2030. And that makes it a target maturity fund, like you find in the public markets.
That's fantastic. Very, very interesting, because I think if you pitched this product 5 years ago, the appetite would be there, but everyone would say, well, this is ridiculous. How are you going to achieve that? Because a lot of the names that started in this market, you mentioned Airbnb, you mentioned Palantir, but also there was Facebook, Robinhood, those names all traded secondary. It was, in most part, I mean, judging from the data we saw back to 2016, one way. They were mostly people trying to get in the secondary market, and the original folks that were leaving that same position had been in from the primary exclusively. So it wasn't like a two-way secondary market, which you have today, which is really, really exciting. So that's I think a perfect idea, and it doesn't sound, I want to say novel, but it's just appropriate for the time. And an interesting part that we'll compliment on is, not only are you helping people achieve better liquidity, and you're a stable counterparty, you've been in the space for quite a long time, you benefit from the other KYC, Know Your Counterparty episodes, because the folks that you're going to be dealing with are also the folks that are oftentimes in the consortium or are broker-dealers, marketplaces, things of that nature. So, yeah, this is becoming quite the ecosystem. And I think this is where people can start to trust in the infrastructure that is being created in and around liquidity facilities, data houses, research, and so on. And I think one thing that I wanted to bring up that's unique about you guys is the fact that you also have the club. You also put out your own research. So if you wanted to just say what the research is focused on historically and on a go-forward basis, that'd be great too.
Yeah, so we are a team of 6 people, and we have 4 people. Each one covers one of the 4 legs of this table called America 2030. So defense, energy, cyber, and AI infrastructure. So everyone makes sure that they know everything about the companies that we have in the pipeline and monitors them, and at the same time scouts for comparables, just to analyze and compare, or for new insertions inside the pipeline, because as we said, we deploy over 3 years, continuously deploy, so there might be new companies showing up in 6 months that we didn't know about them yet. So we the member looks at the company, keeps updated a research piece over the year, and make sure to know everything that is going on, both on the business side and the corporate side. And then we talk once a month, and we decide which one are more interesting cases to allocate. When we look at the companies, one of the things that we look at the liquidity. So we would not invest in just a really fancy or fantastic, very interesting startup. Right. We need to make sure that there is a price, and that is a liquid price. So we make sure that we scrape the emails we receive from the brokers. We make sure that we have liquidity and confidence that we can buy and sell. And so we give a liquidity index to the name. And those are the names that we end up looking the most. So even if we have a pipeline of 100 names, we probably at the moment are focused on 20, 25 names because that's where we have liquidity. And so those are the names where we keep the research more up to date.
Great. And I'm also curious, I mean, do you think liquidity begets value? You know, in some ways we are seeing a correlation between the higher liquidity names are actually able to maintain a lower volatility and have a better price trajectory on them. You know, with the exception of things like an Impossible Foods or GoPuff, you know, that were super liquid for a minute and then not so liquid and the price fell apart. But I'm curious if you're seeing that as well.
No, the liquidity is an important part and shows appreciation in the name, right? Liquidity, though, is done by demand, supply and demand. So, for instance, there are names where there is only demand, and is that name liquid? I don't know. So it's really where the trades happen, where the demand meets the supply. I make an example of a name I don't invest in, but Stripe. Stripe continuously provides, price points, same
right.
as SpaceX, for instance. There's continuously trades matching, so you know where the paper is trading. And then, with regards to the examples you made of GoPuff and Impossible Food, it's a difficult job for venture capital to understand whether something is already in the past and you're looking at it from the rear mirror, or if you're looking at something that still has to develop and to catch up and to grow, and the market underneath has still potential to grow. Right. With Impossible Food, we made that mistake. We looked at the mirror and we said, these alternative proteins would be huge, let's buy them, and we were not right.
Right. In a way, it's how do we judge between a fad and a trend?
Correct.
In a lot of ways. So I would love to just get a sense. We always like to ask folks on the show, is the market going to be up, down, or sideways, and why? What are you thinking about the general market, not just your individual sectors?
So I think the market as a whole is not cheap because some of the valuations is actually higher than they were at the peak of 2021 in terms of multiples to sales and to growth.
Right.
And there, what happened with AI. The AI has this. This happened because if you want a pure AI play, you have to put your money into the private markets. That means that all of the big guys in the public market had to get exposure via the private market. So this created a situation where those names are really well bid, and so they bring up the total valuation of the market and give the impression that the market is expensive. So inside this market, I think the market can do well now for two reasons. One is technical. I believe that the blur between private and public markets, it's increasing. They're becoming more similar. So i.e. the private markets are growing in terms of number of people who look at them and invest. And that's a technical lift for the whole market. So that bid is there, that technical element is there, and I'm very positive, and that's why I wake up very motivated every morning. I think it's a good time to be here. The second thing is that I think that interest rates, above all in the United States, will not go as high as some of us expected in terms of inflation. That is because
I agree on that too.
Interest rates can follow inflation 1-to-1, and then they should go high. They can follow the economy, which is is not going to fire up at like tiger times of Asia in the 90s, and or they can follow politics. And I think the political element at the moment is dominant. We know we have a very dominant president in the United States who likes to talk 24/7, basically. So I think that the rates will more be set by his policies and his attitude and his goals, and rather than set by the inflation. You have seen also one news is that there is a reform in the banking system in the United States that allows the bank to buy way more treasuries. That is another technical reason for which we think that the interest rates will be kept lower, and that will be beneficial for private markets.
Yeah, I think a lot of this does point to the benefit of private markets. I always question if it's to the benefit of the public market. To a certain extent, are there going to be more IPOs? Are the names going to come to light? Probably not, in my opinion. And sometimes that winds people up. But I think the way you operate in the market, you're almost not really caring. If it does an IPO, great. There's going to be secondary liquidity on the other side. You do liquidity screens on the way in, which PM Insights always happy to help with. But I think that's key. It's almost having faith in those markets, and a lot of those names that withstand the test of time, let's say like Stripe, the longer they're in the market, the more hands that they're held in, and the more liquidity they'll typically have, as long as they are a trend and not that fad. So.
Yeah. So one consequence of the private markets growing from the little child to the public market status is the lack of IPOs or less IPOs. We've made a lot of money with Anduril, and we made a lot of money with Palantir. Completely different stories, but both of them, in either cases, it wasn't really the IPO that made us make money. Palantir, people forget, has been private for 16 years.
Right.
And now SpaceX, where we are making a ton of money, it's private for 15 years. So it's not necessarily to buy and wait for IPO and M&A. And that's also why we changed our model from IPO Club 1 to America 2030, because that needs to be reflected in the compliance and the docs and the rules of the functioning of the fund. We couldn't have done this pivot by keeping the structure of IPO 1, which was geared towards IPO and M&As.
Right. No, that's great. Well, irrespective of why people want to get in touch, America 2030, Pre IPO Club, hang with you for a bit, what is the best way for folks to reach out? Do you have a website? Do you have an email? Do you have a phone? How do you want people to reach out?
Yeah, so the website is very easy. It's ipo.club. So easier than that. It's difficult. If someone is like an IRA or an investor looking to get exposure to this American defense security AI infrastructure, can email us and the team would be in touch. The email is members@ipo.club. So we're very happy to answer your questions. And then we have a page on LinkedIn that you can find by just searching for IPO Club or America 2030, where you can keep up to date with what we are up to in terms of research and analysis.
Great stuff. Well, truly appreciate having you on today for KYC, Know Your Counterparty with PM Insights. Thanks a lot.